Hello and welcome to the first video at For Example. Here we talk about not only smart money concepts, but actual institutional trading. You see, I've been a retail trader for many years and it was always failing me. It was never working. I was always in a position where I was being stopped out of positions, or, I'd get some profits, but wouldn't have that continuous consistency. And what I've come to realize is that actually you need to be on the side of the market for those people who are actually moving the market, which are the banks, financial institutions, right? And so in this first video, what we're going to be talking about is kind of the beginners level concepts of institutional trading itself, all right? So the reason for the creation of this channel is obviously to highlight in the name that there is ample opportunity in the markets to be able to get in, set positions, and actually do what it is that you want to do as a trader, which is to have the position set up so that you can live your life and that you can actually enjoy profits as you go along. Now, in this video, like I said, we're going to be talking about how to identify liquidity and giving you just the basic beginner steps of what liquidity is, how it works. It might be a term that you're familiar with. It might be something that you've never heard about before, but we are going to be getting started with that. So the first thing to say really is what is liquidity? Well, liquidity is money. The entire market, the entire FX market, which turns over trillions every single day, is liquidity. The markets cannot move on thin air. And so liquidity has to be built up in order for price to move. All right. And that's the first thing. Now, banks are actually responsible for around 70% of all FX transactions. And so they're always the majority money holders in the market. One way they maintain this position is by taking money from other dealers in the market. So if you have ever traded and have ever been stopped out, if you have ever wondered why your trade has gone to stop loss and then moved in your direction, well, you've come to the right place. You've come to the right channel. This is all the kind of things that we're going to be talking about. Now, before we kind of get into the third point, I guess one thing that is really important to say is that as a trader, everybody comes into the markets because they want to make money and they want to be proficient and they want to be an expert. But the thing that a lot of people lack when it comes to trading is that they don't take time to acquire the skill. Trading is an elite level skill set. It's something that has to be done over a period of time in order to become great at it, in order to become consistent. Just like anything in life, to become consistent, you have to practice and you have to practice. The issue is that when you're practicing with, you save money, your lifetime earnings, or, money that you've worked hard for, psychologically it becomes very difficult to take on the lessons that you need to learn because you are losing money. All right. And that's why I always say, if you are a trader of any sort, if you've been a retail trader for many years and you've stumbled across this video, all of that time that you spend trading is not in vain, because it shows you and has taught you, if despite having lost, it's shown you and taught you what you need to do in order to progress. All right. And it's kind of catapulted you to look for these concepts, which people call smart money, but I personally refer to as institutional trading. Now, we know that one of the most taught trading patterns for beginner traders when they first start learning how to trade are double tops, double bottoms, support, and resistance. And what does support and resistance normally look like? It normally looks like somebody going, okay, where have we seen price kind of hover around? It's been here, here's some support and resistance. It keeps coming around this price area. And so once it hits here, it hits a third time, second time, it hits a third time, and then it flies off. And that's usually the way people are taught. Okay. Now, the same concept applies here when it comes to institutional trading, but the way you interpret it is going to be very, very, very different. The fact of the matter is that despite all of these patterns being taught to traders, support, resistance, double tops, double bottoms, head and shoulders patterns, whatever you want to call it, 95% of retail traders actually lose money in the market. So there has to be another way, and there is. Now, one thing, if we look here on this chart, we can see a few different ways in which liquidity is being built up, right? Right here, we have what we would call support. Yeah. So we see that price is coming into this area, it's bouncing off, it's coming into this area, it's bouncing off, it's coming into this area, and then flying down. This is what retail traders are taught. However, what people don't appreciate or know or even understand is that actually what happens is when people are setting their positions here and here, they are placing trades here, which means that their stop losses are here, yeah, above this area. Now, what are stop losses? Money. It's money that you are willing to lose, money that you've set aside to say, if the trade doesn't go in my favor, I'm going to lose that money. So your stop losses are above these areas. Let's say you've entered the trade here or entered the trade here or any one of these highs right here. Your money is sitting above that area. So because there's money there, what we can do to represent that money is draw a line. And you can place a little money sign above it to signify that this is where liquidity is being held. There is money above here. Stop losses are above here, whether it's 5 pip stop loss, 10 pip, 20 pip, 30 pip, whatever it is, there is money above here because most retail traders will be taking these positions. Now, the same concept works here on the low. All right. So you've got this area, this specific area where price, this area of support, excuse me. Sometimes I forget the terms. Support, where price has been bouncing around this area, okay, and it's build up, and there is simultaneously liquidity sitting underneath this. Stop losses, money. People are buying. So you see this, people probably buying here, put their stop loss to down here or put their stop loss there or wherever, right? They're seeing this continually happen. And so they place their trades and there are stop losses that are sitting below that particular entry. So we can signify that again here as liquidity, because there is money sat underneath these trade orders right there. Now, what this is called, right? What these two are called are equal highs, and these are known as equal lows. Equal highs because price is coming to relatively the same area, all right, where the stop losses are above and people are setting their trade orders, their bearish trade orders. We're in bearish price delivery here. And double bottoms, as known by the retail traders, but actually equal lows when we refer to it in institutional trading, in that people are setting positions here and there's money underneath. So we've got equal highs and equal lows. So do you see how the same idea of double tops and double bottoms is being used, but the interpretation is very, very different. Now, let's take a look at what happens when price encounters these high value areas of double bottoms, I keep saying double bottoms, it's the retail trading, or equal lows or equal highs. Where else can we see equal highs or equal lows? Let's just mark them all up on the chart. Where else can we see some? I can see some equal highs here. I can see some equal lows here. And once you come to understand this concept, you'll spot them everywhere. But notice, right? Notice that even though we're seeing all of these equal highs and these equal lows, notice what price is doing around these places. It's coming up to take money. So for example, this would have been resistance to somebody. Someone could have seen this high, price moves down, they see this coming back up, they see this as resistance, they see this kind of ranging action that happens, and so people are ready to sell down. And when they sell down, what happens? Their stop losses are taken, right? They sell down. Oh, this is going to be a double top. Let's sell down. And they're expecting it to kind of move all the way down there, for example, because that's what they've been taught, that a double top is occurring because price is kind of ranging around this area. They push down, they're in a bit of profit, and then instantly they're taken out for their stop loss. It's the same concept happening here. Again, we've got prices ranging here. We've got it comes back to this area, then shoots up, comes back to this area, then shoots up. So people come down and think, yeah, this is an area of support. I'm going to buy. And they buy and they get into profit. And then what happens? Their stop losses are taken out. Liquidity. The banks come for their liquidity. And then they're wondering, why? I thought this was supposed to shoot all the way up, so on and so forth. It's because the market moves on liquidity, and the banks are continually trying to find areas, high value areas of liquidity for them to be able to come and snatch from the market. So we see here that price is actually holding in this area. It then takes the liquidity low, it takes this liquidity high, it pushes down, it creates equal highs. Oh, this is even, again, look, even if we notice here, again, this is an area where people would have said, right, I'm going to sell. This is resistance right here, no? Right, you get this push down, price comes back to the area, pushes down again, and this is about to be the triple top, as it were. Price comes down, pushes down, it takes the liquidity of these equal lows, all right, this support resistance, so it stops whoever bought here. Some people took this as a triple bottom, double bottom, whatever you want to call it. Price comes and takes their stop losses and then does what? Shoots up to not only take the liquidity and the stop losses of this high value area for people who thought this was a triple top, but also this high value area of equal highs. All right. So we just see, once you spot this and you identify what liquidity is, you can now see how the markets are continually moving to collect collect stop losses from high value areas. All right. So that's the first thing. Now, as we go along, as we continue in this series of institutional trading concepts, we will be developing on this. We will be building upon this. I will also be releasing a Notions document of all of my trades, which some of you can see here. I have a Notions document, which consists of all of my trades, the higher time frame narrative, London session, New York sessions of chart markups once we get to 1,000 subscribers. So once we get to 1,000 subscribers, this is a new channel, fresh. But once we get to 1,000 subscribers, we will be releasing content in the form of a Notions channel. I'm going to make sure that you guys can actually see that, because I was recording on Zoom, so I'm not entirely sure if it did show you everything, but hopefully it did. But I have, like I said, Notions page of all different chart markups. I also have my Telegram page as well that I will be giving access to once we reach 1,000 subscribers. So that being said, hopefully this video has been helpful. Hope you take away some lessons from this, and let's get trading.